Did you know it's possible for two retirees with the exact same amount of retirement savings to end up paying dramatically different amounts in taxes? How could that be, you might be wondering? One family keeps far more what they spent decades building. The other unknowingly sends tens or even hundreds of thousands of dollars more to the IRS over the course of retirement. And the surprising part, it often has nothing to do with how much money they have. It has everything to do with how they withdrew it. And that's exactly what we're going to cover today. Because one of the biggest retirement risks isn't market volatility, it's unnecessary taxes. And the good news is that many of these taxes may be reduced with proper planning if you start early enough. And before we get started, if you'd like help reviewing your own retirement tax strategy, click the link in the description below to schedule a complimentary consultation. We'll review your personal situation and help you identify opportunities that may make sense for you. Now, let's get into it. The first thing to understand is that retirement doesn't automatically mean you're in a lower tax bracket. In fact, for many retirees, the opposite happens. Throughout your working years, you're contributing to retirement accounts like traditional IRAs, 401k plans, because you're told you'll probably pay less taxes later. And you know what? Sometimes that's true, and sometimes it isn't. Once you retire, your income can come from several different resources: Social Security, pensions, required withdrawals from retirement accounts, investment income, part-time work, maybe some rental income. When all of these are added together, many retirees are surprised to discover they're paying more tax than they expected. And here's where many people make an expensive mistake. They only focus on growing their retirement savings. Very few people spend enough time planning how they'll eventually withdraw that money. Accumulating wealth and distributing wealth are two completely different skill sets. The next strategy is understanding which accounts you're spending from. Think of your retirement savings as buckets. One bucket has taxable money, another has tax-deferred money, another may have tax-free money. Most retirees naturally withdraw from whichever account feels most convenient at the time. But convenience doesn't always equal tax efficiency. Sometimes, changing the order of withdrawals can potentially reduce your lifetime tax bill. Not every year, though, but over 20 or 30 years of retirement. That can make a meaningful difference. The third concept is something many people overlook: tax diversification. Most people understand investment diversifications. They own different types of investments, but relatively few people think about diversifying how their retirement income will be taxed. If all your retirement assets are tax deferred, you have very little flexibility. Every withdrawal creates a taxable income event. If taxes increase in the future, guess what? You'll have future tax options. Having money spread across taxable, tax deferred, and potentially tax-free accounts can provide you with greater flexibility in generating retirement income. Now, another area that deserves attention is Roth conversions. Now, before you assume Roth conversions are right for everyone, guess what? They're not. But for the right person, during the right years, they can become an important planning strategy. The years after retirement, but before required minimum distributions begin, often create a unique planning window for some retirees. Your taxable income may be temporarily lower, and that can create opportunities to gradually move over portions of retirement savings into Roth accounts while managing the taxes owed along the way. The key word there is gradually. This isn't something that you usually want to rush. It's something that you carefully coordinate over multiple years. And that's why planning matters, because every decision affects the next one. Here's another mistake I see quite often. People wait until required minimum distributions begin before they start thinking about taxes. Now, unfortunately, by then, many of the best planning opportunities have already passed, and it's too late. Once required minimum distributions begin, you're required to withdraw money whether you need it or not, and those withdrawals can increase taxable income. They can potentially affect how much of your Social Security benefits become taxable. They may even increase certain Medicare costs depending on your income. Planning ahead gives you more choices. Waiting usually gives you fewer. Another important consideration is where investment income comes from. Different investments may be taxed differently. Interest, dividends, capital gains, ordinary income, each can have a different tax treatment. Now, understanding how all of these work together is one reason comprehensive retirement planning is so valuable. Now, here's something I always tell my clients. Good tax planning isn't about trying to avoid taxes completely. It's about paying the taxes you legally owe. No more, no less. Unfortunately, many retirees don't realize opportunities existed until years later. And by then, those opportunities are gone forever. And that's why proactive planning is so important. Every year creates new opportunities. Every year also closes others. The goal isn't finding one magic strategy, it's coordinating dozens of small decisions that work together over time. And that's where the biggest impact often comes from. At Coyote Financial Services, we don't believe retirement planning should focus on a single product. It should focus on creating coordinated strategies. And that means reviewing your retirement income, your taxes, your investments, your risks, your estate planning goals, and then designing a plan that fits your specific situation. Sometimes that includes Roth conversions. Sometimes it doesn't. Sometimes annuities make sense for part of someone's retirement assets. Sometimes they don't. Our job isn't to force every client into the same situation. It's to help you understand your options so you can make informed decisions with confidence. If you've accumulated significant retirement savings and you're wondering whether there are opportunities to improve your tax efficiency, we'd be happy to have that conversation. Just click the link in the description below to schedule a complimentary consultation. We'll review where your retirement income is expected to come from, identify potential tax planning opportunities, and discuss strategies that may help you keep more of what you worked so hard to build. If you found this video helpful, be sure to subscribe because every week we cover retirement income planning, tax strategies, wealth preservation, and ways to help you make more informed decisions. Thanks so much for watching, and I'll see you in the next video.